Thank you. Thank you, Apagut, for the learnings and insights. So for questions, as we said before, if you have questions, please follow up later with the speakers in the other area after the talk. But yeah, lots of food for thoughts about how to approach new games or businesses. What are your thoughts, Micha?
Well, yeah, it's just a reminder on the question. So I don't have it, but you have it on your card. There's a QR code, so when you show the camera on it, you can put in the questions, and those will be answered. They'll get a little bit of a leeway. Not everybody is comfortable with ranting off the cuff, but there will be a little bit of leeway for the people who are talking to answer those questions while they're over there, or maybe even answer them later on in some kind of a follow-up after this event. But Alpagod, amazing talk. So I took a lot of notes, like. On the headwind side, we got the decline of largest segment in gaming, which is mobile, and that's why the decline is so significant. We see people going back away from the metaverse and back to the real life. There's a competition over the screen time, and that competition leads also to the competition to the money spent, like where you have to choose whether you continue with your Netflix or whether you're going to pay for the next IAP. A lot of people are continuing with the Netflix. The inflation, of course, is the main source of this, and privacy and geopolitics. But there's a lot of positive in this talk as well. More gamers, more downloads, the potential of 50% more people who are not currently playing games that they would be playing games. They just need to find the right type of genres, the right type of opportunities, and the fact that the decline as well as the incline doesn't last forever. So the to-dos just to take away from here, just to remind people, is like the genre diversification as well as diversification of monetization, building on top of the IPs or getting IPs to build on, and really analyzing everything from all angles. Something might be a clear instruction, but if you don't do it the correct way, you will still fail. So it's not very simple. You still need to be mindful and be somewhat afraid of doing a mistake. So just look at it from all angles, and that's the way to the next incline. So who's the next one?
Yeah, so let's continue also on the theme of how do we approach games in the current context. And the next panel coming is about recession versus the game industry. And there's been a series of events that have affected the gaming industry the past 3 years. Among them, a pandemic that led to a set of events culminating in soaring markets through the end of 2021. Then money was easily available, and innovations in crypto and NFTs were the trend. And 2021, as a reminder, closed with the downturn, as IDFA, as we talked about it with Eric, in April also didn't help. So preparation were made for an unexpected recession, translating to, as maybe some of you have experienced, a number of layoffs across the gaming and tech sectors. So I'm super excited to welcome on stage the next panel to discuss the current position and who can represent as well the insights from investment side, but also company side. So first, let me introduce to you Chris Petrovic, who is the Chief Business Officer and board member at FunPlus. Then we have also Dara Leung, a Managing Director at the Raine Group, and Laura Taranto, who will be the moderator, product management leader at BigFish, and Micha Katz, Managing Director at Aream Co. So welcome on stage, and thank you.
So today I have the privilege of sitting with 3 people who will be our guides navigating rather turbulent investment and deal waters. After, as Sophie mentioned, the soaring markets that we had in 2021 and most of 2022, we're now experiencing post-COVID normalization of the gaming ecosystem, and our new reality is under a recession. For many, we want to understand how people like Chris, Micha, and Dara approach companies and studios from a valuation and strategic opportunity point of view. And I would say that desire to understand grows exponentially in the face of market changes or uncertainty. So let's begin. My first question is for Chris, but obviously, please everyone jump in afterwards. The market has taken a sharp turn for what's been business as usual over the last 10 years. How have changes in the market affected your strategy, approach, and day-to-day work?
Thank you. Great to be back again in Istanbul. So I think all of us here in the room have heard a tremendous amount of data and insights from the last few speakers that have been up here on stage, and we've been taking that data in over the last year or so to try and make sense of it all. And I think, you know, it's easy to try and pinpoint a single answer for why we are where we are. And I think the conclusion that I've come to, and many of you have come to, is that there is just, you know, we have this series of events that all happened one on top of the other at the same time, which is unprecedented in our history as an industry. And I think we've also suffered from, quite frankly, a little bit of complacency of the industry being up and to the right and being an emerging market, a growth market relative to other sectors in gaming. And so I think now what we're faced with is a lot of dust and a lot of noise in front of us. And the realization that what has worked in the past may not necessarily work in the future. And I think our company, like many of you, are working on and perhaps even sometimes struggling trying to figure out what that means and looking through the dust. I think the thing that we have as our North Star is, you know, what you saw in terms of growth rates for the mobile industry. And I think we need to take heart in the fact that we are in the right industry, right? Gaming is the largest sector of entertainment. Mobile is the largest sector of gaming and the highest growth, and will continue to be. So I think if we wanted to think about going elsewhere for a career, we're not going to find any more of a dynamic or high growth sector. So I think, you know, we are all universally, maybe with the exception of one company that Eric mentioned, aligned in trying to figure this stuff out, because we all need to in order to survive with each other and amongst ourselves. And I think tactically speaking, from an operational perspective at our company, some of the tentpoles that we have in our arsenal that are guiding our strategy are a lot of what's been discussed. So obviously the value of IP, both your own and licensed. I think, you know, our company has for a long time now had a vision statement that every employee has on their desk, which is to be one of the best interactive entertainment companies in the world. And that is not something we came up with just now, kind of post-COVID. It's been something that's been on people's desks for the last several years, and you'll notice the word gaming is not anywhere in there. And it's because we firmly believe that IP creation is at the center of success. And I firmly believe that the next Marvel and Star Wars level IP has an increasing chance of coming from games more so than the movie screen or the TV screen or a comic book. That's just the generational shift that's happening where our audiences are experiencing media for the first time. The other thing that we think about, the second tentpole of the three, is this notion that was discussed about cross-platform. Cross-platform can mean many things. It could mean going direct to consumer with billing options for your mobile game. It can mean building games from scratch that can be present on multiple devices and screens and potentially in a synchronous way. And we're looking at all of that because it is a larger total addressable market. The technologies are such that consumers are increasingly expecting to have an anytime, anywhere, any device experience with games like they've had with books, movies, TV, and music for a long time. And the third tentpole, which I think is the most important relative to what we've been hearing here, is that we need to look outside of ourselves for what is next when it comes to marketing. I firmly believe that we are in the third act of mobile, right? The first act was the app stores. The second act was the transition from premium to free to play. And now the third act is living in a post-IDFA world. And I think for a long time, mobile has been looked at as a leader in the mobile app ecosystem when it comes especially to marketing. And I think now it's incumbent upon us, and I tell this to anybody that will listen, is we need to look outside of ourselves and look at all of the interesting and successful consumer tech companies on the internet, mobile, web, or otherwise, that have survived their entire lives without focusing solely or primarily on performance-based marketing. A lot of great brands, a lot of great companies have been built selling everything from razors to clothes to streaming music online and through mobile apps, but they've done it in a more quote-unquote traditional way. So I encourage our industry to think about moving away from user acquisition mindset and move toward integrated marketing, omni-channel marketing mindset, because that's what's going to bring us into the next level of innovation. And finally, I'll just say this is a tentpole for all of us. Continue to be innovative in the development of your creative endeavors, right? Innovation is going to continue to move us forward. And again, that will involve doing things differently, right? Not doing it as it was to create the next version and doing iterations. I think we're going to need to be a lot more innovative in how we bring games to market.
Chris, you mentioned complacency, and I think this is psychological effect of like hangover from 10 years of double-digit growth that just felt like granted in the mobile industry. And so decrease last year, there is basically an effect of like back to fundamentals, back to basics for games because of this. What free-to-play has brought is sort of price elasticity, finding your best users and getting extremely high LTVs from this. This is obviously a bit broken at the moment. That has been the go-to approach of many developers. And what now I guess market is seeing is back to finding fun, finding gameplay that might bring more DAUs, probably a bit lower ARPDAU, and but be more healthy as an economy. I think Eric mentioned Survivor.io, which after all is a game that took its inspiration from an indie Steam solo developer game with like a beautiful, one finger mechanic, but very deep RPG elements. So I think there is obviously moving away from that years of performance marketing driven world back to games that are more meaningful gameplay-wise as well.
Anything to add, Dara?
No, I think that really well covers it.
All right, I'm going to jump now, look into a little bit more deals. So this one's for Micha. Thinking of gaming and related tech deals you've completed in the last couple of years, how would you classify them? How are they performing today? And what do you think has been fundamental to their outcomes?
Right, yes. So Aream, we're a gaming-focused investment bank, so we help studios on their exits and investments. And we had, over the last 3 years, done something like 35 gaming M&A transactions. So giving you a bit of a pulse of that market. On the classification first, so 2 points there, how we classify them. One topic is like, who are the buyers? And we did this analysis recently, it was quite striking, like back in 2020, 2021, 80 to 85% of our transactions were companies bought by publicly listed companies, including Chris, back then.
You're welcome.
And this ratio, over the last 12 months, has basically inverted. It's now 20% done by public companies. Meanwhile, the deal activity has actually not changed. We have done as many deals in 22 as we had in 2020. 21 was a bit higher. So there is deals are happening. What we have seen is the rise of a new universe of buyers who weren't really even around 2 years ago. We see VC-funded companies who would buy their competitor something complementary portfolio-wise. We see private equity-owned businesses on a roll-up strategy. We see just private buyers who don't have their share price to look at and don't need to use that as a currency, who are more active and also have a market which is ripe for them to consolidate. So that's on who are the buyers. Then on the types of deals and how to classify that. Again, 2020-21 was this amazing time of mobile consolidation driven by kind of massive growth in the industry, high share prices for some of the buyers, kind of grabbing independent studios and large properties. This obviously has decreased a lot, particularly for, as we were discussing, games that are studios that have been relying on performance marketing or classic sort of in-app high whale spend. At the same time, we have done and seen deals happening in other segments in work for hire, which is very hot, in esports, where there was a massive deal about a year ago. In obviously PC console, which is a bit of its own universe, more kind of connected to the hardware cycles and release calendars, so that's on. So there's a shift happening here. Finally, on how are those companies performing and what is driving that success. So there's a variety of situations. It's gaming, it's arts and science, and more art and creativity. So we have seen things that have been pushed or delayed. Some situations have outperformed, others haven't. I think a criteria for, or clear characteristic of the successful M&A transactions has been deals where the buyer had a strong vision for the kind of operational, strategic synergies, and sort of adding value on product side, UA, expertise, and some deals like when Active bought a farming game, a small but fast-growing farming game called Melsoft 2 years ago. This is now the second farming game in the market, and has probably, just based on public data, tripled in size because they really took a view of, okay, we can improve X, Y, Z with our expertise. Same when Politica invested in Ace Games here in Istanbul a few weeks or months ago with that same vision, and this is already visible in the numbers. So I think the key criteria is having that synergetic mindset of 1 + 1 equals 3, and more than sort of the financially driven approach of let's buy as many studios and see what happens.
I mean, that's fascinating. Correct me if I'm wrong, but when that shift of public companies versus private companies behind the deals, I mean, private don't have to declare what they buy, right? So it ends up being, it's an absolutely fascinating, I think, statistic.
They usually declare it out of ego, but maybe they don't have to declare the details as much.
Yeah.
Yeah.
So this one's for Dara. Since you have the benefit of seeing both sides of the deal, what are the typical pitfalls for those looking to buy companies and those looking to sell companies or anything else in today's market? And how do you think it's changed?
Yep, absolutely. Happy to address that. So kind of following on what Micha said, the last 2 years have been absolutely extraordinary for deal making in the games industry. We saw more consolidation than ever. And I think I'll start from the sell side. You know, what pitfalls that we've seen sellers have is not appreciating that the last 2 years of go-go valuations are largely over. Capital is extraordinarily expensive, both on the debt and equity side. I think Micha touched on this, but for all the public companies that acquired a ton of businesses over the last few years, they're having their own reckoning right now as they see their share prices fall, their own multiples drop. And it's extraordinarily challenging for them to pay above what their own multiples are, which obviously a seller who has very strong growth still want, right? You guys are the guys with the vision. You guys are the ones with a high growth asset. You demand and deserve a very high multiple, but they just can't pay that anymore because they're restricted by their own valuation. I think the other thing, other than capital being very expensive, which Eric touched on earlier, is the fact that there's also more sellers coming into the market than ever before. So not everyone might see this, but there has been some indigestion over the past few years where big companies are looking across their portfolio of assets. And if it's not core or if it's not profitable, they're looking to shed that just to refocus. It's not so much about the lack of profitability of those companies. It's about refocusing on what's absolutely important to them. So those types of companies are coming into the market. Those sellers have very low thresholds for what they're willing to sell them for. On the other hand, you have a lot of companies that have successfully raised capital over the past few years. They did not expect the market to shift this quickly, so they're coming back into the market to raise capital. And a lot of these guys are super strong, great fundamentals. They just maybe miscalculated by 6 months how quickly the market could turn. And when they were underwriting their growth plans, when they were building and when they were investing and when they were growing their people and UA spend, what have you, might have missed it a little bit. So they're also coming back. A lot of these guys, luckily, are backed by great investors, really strong funds, and they can continue investing, and that's what we're seeing. But what that means for everyone else who might not be in that situation means that those funds' capital is accounted for. They're backing their winners. And I think the other thing that people should be aware of is when you see in the news, you know, really strong valuation, companies coming back and raising at higher and higher values despite market conditions, a lot of those things end up being quite structured. That's, you know, what you don't see, especially if the companies aren't public, as people have said, is that they're structured, their preferences, there's M&A blockers. So they're restrictive, but it is kind of funds backing them. So what does this mean for if you're a seller? I think if you're a seller, you just have to have a very, very strong package story, have the financial forecast that's optimistic but realistic, And you also need to get all your shareholders who have decision-making power around the room and have agreed upon valuation threshold of where you're willing to transact. I think what we also see are companies that come into the market and there's disagreement at the last second. One board member, one shareholder that comes in is like, this is too low, we can't sell at this price. So rather than waste time now, come up with those values in advance. And then when I take it on the flip side, what does this mean for people who are buyers? Despite market conditions, the best assets are still demanding a premium and they still want the highest possible value. So you're gonna have to be creative. I think the other thing that you have to be realistic about too is that we see some buyers who are shutting down M&A. You know, can't spend capital, too expensive, we have to focus on the core. That's not realistic. Look at yourselves in the mirror. When was the last time you have really innovated a new game? When was the last time you've really driven organic growth? A lot of your innovation comes from M&A. So be realistic on if you can grow without M&A. That's what I would say. And then on the willingness to pay, the best assets are going to demand a premium unless it's a very hairy situation. These companies can wait 3 to 6 months, 1 to 2 years. They don't have to transact in this market environment. So be realistic about what your vision and strategy is. Be realistic on whether or not you need inorganic growth to continue pursuing that vision. And if you do, you're going to have to be creative. You're going to have to look at take privates. You're going to have to look at corporate carve-outs. You're going to have to look at secondary transactions, buying out early shareholders. But there's still definitely opportunity for transactions today. People just have to be more realistic in this current environment.
One thing I would say, just hearing these two speak, is that it echoes the importance of surrounding yourselves with super smart people and advisors, because a lot of the words that she was saying went over my head, you know, when it comes to you know, market realities. And I can imagine for those of you that love building product and like building teams, that you would much rather not have to focus on knowing these details, and you only have so many hours in the day. So like Aream, like Raine, you know, surround yourself with great advisors that have your best interests at heart for the long term, so that they can help you understand this broad ecosystem. I think from the perspective of somebody that's been fortunate enough to operate in this market for a long time, and have been fortunate enough to do some great M&A transactions here with Turkish companies like Peak twice and Rollick and Graham Games, I notice and I understand the weight that these processes put on small companies. So much so that I remember in one particular situation when I was at Zynga and we were preparing a team to interact with one of the companies that we acquired, I looked around the room and realized that there were more people on this quote-unquote deal team than there were employees at the studio that we were buying, right? And if you just assume that each one of those people sends one email a day to the two founders asking pretty benign questions, that it would overwhelm them with just having to deal with the administrative headache of having to respond. So surround yourself with great advisors, whether it's investors, board members, you know, investment bank advisors, that can help you navigate this market and help put you in touch with the right people, introduce you to the right people, get to know the right folks in the ecosystem, and then you continue to focus on what you love and know to do best.
Micha, anything to add?
I think on more kind of positive note of, obviously there is valuation kind of mismatch or higher, or we're coming from years of high fundraising prices, etc. Putting that into perspective, taking a step back from like gaming, more like TMT, the fundamentals of gaming are still like extremely healthy, especially like comparing to the downturn we're seeing in software or other tech segments, where nobody in this room has been in the world of like the 100x next 2 years ARR maybe, and that sort of projections. I think gaming as a sector is driven by kind of current profits or future profits. There's always a path to that. A lot of the studios can operate profitably, maybe growing a little bit slower, can wait, can grow the next game. So there's a bit of that feeling of, okay, let's clean our houses, let's work on our next product, take it a little bit slower. There's still people who need to transact for X, Y, Z reasons, but there is just a more, bit probably slower, but healthier environment for that, and it's not all kind of doom and gloom, especially if you compare to what people have seen in other segments.
I think this is great advice for anyone that's looking to start a company and they want that company to be acquired, or anyone that's actually looking to acquire companies. So I hope everyone's taking notes. I think we can do one more question. This one also for Dara. So we've talked a little bit now about what to expect and what studios can do. So going into this year, what do you think is the outcome going to be for the deals? What do you think the completed deal flow in 2023 is going to be?
Yeah, so I think this year, what's already happening, we're into March. Lots of things are in the market. We think that there are more things that will come to market. And I think certain deals will end up stalling out. I think there's going to be two categories of sellers in this market. Ones that do not, unfortunately, have strong fundamentals. And there's going to be very few companies who can digest that. What we've seen happen is, if that is the situation, typically it'll be a management buyback of the company. So they'll return capital to shareholders, or if they're part of a large corporate, they'll buy themselves back, potentially with some private equity funding. So we have seen successes of that. And then the strongest companies out there is a threshold at which they will not want to sell. They would rather hold out. And I think until the market turns, until there is access to financing again, and until there's more creative solutions for capital, which we're starting to see funds create, they're going to hold out until they get the value that they deserve, because their own capital is expensive too. You have a really strong company, you deserve to wait until this market rides out, because there will be a buyer at the other end of it. So 2023, we believe, will be tough for kind of large closed deals, but it will rebound after that.
I think, Dara, you mentioned before people looking at their portfolios, trying to optimize. I guess you probably see the same deals are getting more creative, more complex. We're seeing spin-offs, acquisitions of games like ZenMatch from Gujarat, which wasn't the whole company, but just the asset. We see structured situations. So there are more complex deals to be done in this market. And I think at a time where we have like large strategics saying, oh, launching new games, developing new games is challenging, is difficult because of what has been discussed earlier. You almost have a market of M&A as your UA strategy. Like, you'd rather put this money with, instead of like the risk profile of launching 3 new games and trying to scale them, you might have existing products and a vision for, okay, we can improve this or this, and we see people looking at those sort of maybe smaller type of situations.
Yeah, that is absolutely true. So I think when the things that we have seen successful are companies with very, very large networks and installs and DAUs, and it comes down to that. For that sort of business, fundamental financials matter a little bit less, because you're exactly right, Micha. They're doing that calculation of UA per user. And for companies that have very, very strong IP, I think Subway Surfers is a great one. It's been around for 10 to 13 years. Super strong IP. Almost every single person in the world has played it. That value goes beyond what the value of each user is necessarily spending on Subway Surfers. It's just getting access to that network.
It shifted completely. A couple of years ago, we had buyers look at deals saying, oh, this is driven by organic traffic. We can't control it. Will it be in the stores? Will it be featured? Will it be in the search results? How can we do UA? What's the ROAS curve, etc.? Now is like Saibo and Subway Surfer, hey, bring me the K factor and virality and the organic flow, and we'll monetize that.
So I think one last thing, and you've touched on it in all your answers already, but if you could kind of distill one piece of advice for studios, and from either side, what would you give them, kind of setting themselves up in the best way possible for this year? So you can bring up something you've already said, but there's been so many nuggets of wisdom. I'd say, what could be the best piece of advice that everyone here could walk away with?
I've been thinking a lot about this question because I wanted to make it specifically targeted toward the Turkish talent ecosystem, because I've, again, had the good fortune of observing through direct deals and also through industry moves what has been happening here in Turkey over the last few years, and working with founders and working with companies here and helping to ensure that their businesses continue to grow even post-acquisition. And I just wanted to share some of my observations that hopefully can be helpful. And again, just take this with a grain of salt, because it is coming from a single voice of a non-Turkish person, but just thinking about it more from a global perspective. I think Turkey has established itself as a clear tier 1 hub, especially for mobile gaming, and I think that will continue. But in order for that to continue at great scale and magnitude, I think you need to be mindful of a few things. I am continually marvel at the fact at how Turkish-centric your employee bases are, by and large. And I think for all of the talent here, you are eventually going to be capped at your ability to inherit or steal talent from other companies if you continue to take a kind of narrow view of what the available talent pool is. I mean, you look at companies like Gram Games in their day, had tremendous success because they took the risk and took the leap of doing two things. Number one, moving part of their teams to other parts of the world to give themselves a global perspective. And two, hiring non-Turkish folks that they brought either into Turkey or into those other locations, because a global employee base more readily mimics your audience. And right, you can get different perspectives, you can get different insights that you may not always have if it's more of a singular view. Number two, and this goes out to a lot of the founders, I love the passion and the competition that exists here, so much so that I have a difficult time scheduling a dinner where I can sit down with two co-founders that are working at different companies because of that fierceness of competition. But I do think that this age has come to embrace the notion of co-opetition here in this market, especially if you're building yourselves up as a single tier one global hub. You guys can be competitive, but I think the avenues of cooperation, especially in this post-IDFA world, as we were talking about, where there's so much dust and noise and trying to figure yourselves out, you can make each other stronger by virtue of being more cooperative on certain fronts while not giving away, obviously, your secrets. But keep that passion for cooperation. But I hope by next year I can get those two co-founders to dinner at the same table so that they can speak directly to each other.
I think for me is, I've been here since Monday. I came to Istanbul for the first time 10 years ago. And it is truly phenomenal from a gaming perspective to see just how ambitious this market is, just going into the rooms of startups, having people back to back to back desks, working from like 9 a.m. And anytime I walk in the office, like the whole crew is there. A lot of you guys are back 5 days in the office. It's not like that in the rest of the world. So the ambition and the hunger and the work ethic is very, very transparent here. The fact that everyone showed up here, this is probably going to be a stronger outcome than certain speeches at GDC. So there is a lot of hunger here. I think the advice that I would have is, one, recognize that it's very, very different and it's differentiated and it will prove out in the long run. I think the second thing is focus on your core. I think last year there was a lot of opportunity with the capital in the market to try new things, diversify kind of outside of what you really know how to do. Look into yourselves, understand what you're really strong at, understand what has previously made your company very successful, double down on that and push through kind of this time in the market.
Yeah, echoing this, definitely it's kind of back to basics, fundamentals. Great companies are bought, not sold. Investors will find you. In the beauty of the segment is people can often bootstrap for a little bit longer, grow organically, even if it's slower, until they find the perfect setup for growth. So you'll be found by capital as it gets more available as well.
So I think the three things: strategic focus, fiscal discipline, and continue with the passion for building games.
Great advice. Thank you so much. If you have any questions, we'll be out mingling in the area.
Thank you.
Thank you.